As a first-time homebuyer, navigating the mortgage market can be a very difficult task. Today, we're going to explore the two most common mortgage options used by first-time homebuyers, which are conventional mortgages and FHA mortgages. And we're going to compare the pros and cons to help you make an informed decision once it's your time to buy. If you have any questions or comments about your specific scenario, please leave those below and I'll reply personally. So let's talk about conventional mortgages and we'll get into the pros of that first. So conventional mortgages are probably the most common type of mortgage used, not just by first-time home buyers, but almost anyone purchasing a home, because you can use them for the purchase of a primary home, one that you're going to live in, a secondary home, maybe one that you're going to use for vacations, or an investment property, one that you're going to rent out and make money on a monthly basis. And the down payments for conventional loans vary from 3% and up. There's really no limit. I mean, not going to put 100% down, but it can really be anything as far as the max down payment, but minimum 3% if you're a first-time home buyer when using a conventional mortgage. Now, let's talk about some of the pros of conventional financing. So you're going to have lower costs over time with conventional mortgages. And the reason that you have lower costs over time is because you don't have upfront mortgage insurance premiums on conventional mortgages, which is something that you actually do have on an FHA mortgage. I'll get into that a little more in just a little bit, or you can watch my video on FHA mortgages where I explain exactly what that means. But FHA mortgages have this additional cost. It means that you're actually borrowing more money when utilizing an FHA mortgage. Therefore, it's increasing the cost over time with that loan. Now, with a conventional mortgage, you can also not have to pay mortgage insurance monthly. Now, I was mentioning upfront mortgage insurance with FHA loans. Well, you have to pay monthly mortgage insurance with either an FHA loan or a conventional loan. But the difference is on a conventional loan, you don't have to pay that monthly mortgage insurance or PMI if your down payment is at least 20%. So if you're putting down at least 20% on the property, you don't have to pay the monthly mortgage insurance or PMI, which is going to reduce your monthly payments. Conventional loans also have higher loan limits. So when you're buying a home, the amount of money you can borrow on that home is going to vary depending on the type of loan that you're getting and the county where you're buying, because there's different loan limits for each county in the United States. But conventional loans across the board have higher loan limits than FHA mortgages do, which means that if you're someone looking to buy a higher priced home and you're in an area where the average or median home price is higher than what's allowed with FHA financing, well, you're allowed higher loan limits with conventional mortgages, so it's a great option. Now, there of course are cons with conventional mortgages as well. When you're getting a conventional mortgage, the credit requirements that apply to any type of mortgage are more strict. They require a higher credit score than an FHA loan, which is 620 minimum versus a 580, or even in some cases a 500 on an FHA loan. And it's going to be a lot more scrutinized than what you would see with an FHA mortgage. That credit is really going to be reviewed in much more detail, and it's going to be a lot more strict when it comes to things like bankruptcies and foreclosures or short sales that you might have had in the past. The waiting periods are longer from when those have occurred before you can get a conventional mortgage than they are with an FHA mortgage. The private mortgage insurance that we talked about, right, PMI, is actually going to be a little bit higher on a conventional mortgage in some cases than it would be on an FHA mortgage. And the reason for this is because the private mortgage insurance is actually based on your credit score, amongst some other factors, but credit score plays a big part in determining the cost of that PMI on a conventional loan, where if you're getting an FHA mortgage, for comparison's sake, the cost of the mortgage insurance, as far as a percentage is concerned, is identical regardless of credit score. Stringent debt to income ratios as well. You have more strict DTI. The amount of money you make monthly in relation to what your expenses are monthly is lower on a conventional loan than it is on an FHA loan. So that means you would qualify for a lower priced property or a lower mortgage amount if you're getting a conventional loan than you would on an FHA because of those lower debt to income ratio restrictions. Now, let's get into some of the pros of an FHA mortgage. Now, FHA, it's more flexible when it comes to your credit requirements. So I talked about how conventional loans are more strict on credit. Well, FHA loans, well, what I was comparing to when I say they're more strict compared to FHA. So FHA allows for a lower credit score, as I mentioned. They're also not going to scrutinize things like bankruptcies, foreclosures, short sales as much as they would on a conventional loan because those waiting periods are shorter when you're getting an FHA mortgage than than they are on a conventional. As a matter of fact, you can actually get an FHA mortgage while you're still in a Chapter 13 bankruptcy, which is something you cannot do on a conventional loan. FHA loans are also assumable. Now, this may benefit you if you're the buyer, because you might find a home that's being sold and the person selling that home has an FHA mortgage that they maybe got in 2020 when rates were in the 2s and 3s, and you're able to assume that loan, which means take over their existing mortgage. And you should check out my video on assumable mortgages to learn more about that. But that's a benefit to you as a buyer, but it would also be a benefit to you as a seller, because if you have a home with a lower interest rate on it with an FHA mortgage that's assumable by your future buyer, it can make your home more attractive than your neighbor's home, who also might be trying to sell at the same time for the same price, because someone buying your home may be eligible to assume your loan at the lower rate, making it more attractive than your neighbor who does not have an assumable mortgage. Seller contributions. Now, you can get a seller contribution on a conventional loan, but you're going to be more limited on the amount of that seller contribution. A seller contribution is money that the seller contributes toward your closing costs on the property. So on FHA loans, they can actually contribute up to 6% of the purchase price toward your closing costs when you're buying that home. On a conventional loan, you're going to be more limited at a lower down payment, because it's going to be limited to 3%. So half the amount that you can receive on an FHA loan. And so if you're someone looking to buy a property and you really need those funds from the seller to help cover your closing costs, because maybe you just have enough to cover your down payment, FHA is more advantageous for you, because that 6% credit should cover all of your closing costs, allowing you to get into the home for just the down payment. Now, there's not all going to be perfect. It's not all pros with an FHA loan either. There are cons. The mortgage insurance on an FHA loan is both upfront and monthly. So I talked about the upfront mortgage insurance premium. I said I get into more detail on that. Well, FHA loans have a 1.75% upfront mortgage insurance premium. This upfront mortgage insurance premium is required to be paid on all FHA mortgages by the borrower. It can either be rolled into the loan, so you're financing it over 30 years, or you can pay it in a lump sum at the time of closing. On top of that, the monthly mortgage insurance, which is called PMI on an FHA loan, or sorry, on a conventional loan, is called MMI on a FHA loan. You'll have to pay that for the life of the loan if your down payment is under 10%. If you make a down payment of 10% or more on the property, which is very rare on an FHA loan, that mortgage insurance will fall off after 11 years. But the average buyer or borrower getting an FHA mortgage is putting down 3.5% to 5%, which means they're gonna have to pay that mortgage insurance for the life of the loan. Now, you can always refinance, of course, pay that off, refinance into a conventional mortgage once you feel you have enough equity to do so. But in the meantime, you're going to be paying that mortgage insurance. And if you never refinance, you're going to be paying it for the life of the loan. Now, FHA loan limits are going to be lower than that of conventional, as I already mentioned. So from county to county, state to state, there's different loan limits depending on the type of loan you're obtaining, and applies to FHA loans as well. And those loan limits are going to be lower on FHA loans than it would be on a conventional loan. So if you're someone that's looking to buy a home in a higher cost area, an FHA loan might not be able to provide enough financing that you need for that purchase, and you'd have to look at the conventional alternative, assuming you qualify. FHA loans are also a little bit more strict when it comes to the appraisal, right? Especially if the home was built prior to 1978 when lead paint was still a thing. But there are certain things the appraiser, when they come out to the home, is going to look at. They're going to put their head up in the attic. They're going to look around. They're going to look for any rotting wood or termites or things along those lines that they might not be looking at on a conventional appraisal. So it's not extremely strict, but the condition of the property definitely plays a part, and it's going to be playing more of a role and factor into your qualifying for an FHA mortgage on the property that you're purchasing. So both conventional and FHA mortgages offer advantages and disadvantages for first-time home buyers. So you need to consider your financial situation, your credit history, and long-term goals when choosing the best option for your home ownership journey. Consult with a mortgage lender to explore your options and find the mortgage that suits your needs best. And subscribe to my channel for more mortgage and real estate videos just like this one.